Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night where I try to answer your questions and try to make sense of markets. Yeah, I think they make sense today. I was okay with it. But in general, they don't make any sense, but that's why you're here, because I'm going to teach you 3 times a week how to be smarter investing, how to become the smart money, and how to understand these markets that truly most people spend a lifetime trying to understand and still get it wrong. Now, before we begin, I got a couple of housekeeping issues. I got a ton of great questions that came in, and I can't wait to get to them. But I want to say I've got some feedback on the podcast, and here's what my plan is. And my plan today was to actually set up an iTunes account, but I had not gotten that far due to some other things that came up that needed my attention. But the initial plan will be to take the audio from the video and upload it to iTunes, and then perhaps eventually turn that into something different where I make a special just podcast only. But for the time being, due to my time constraints and the fact that I have no employees, my time is a bit busier at the moment, and I just can't dedicate to doing a whole separate program on top of what I do. In addition to that, for those of you who have loved ones, family, friends, coworkers that have been afflicted by the coronavirus. Now, I know no one's reached out to me and mentioned that, but I imagine in the pool of viewership here that somebody is. I just want to let you know that I understand that it's difficult what you're going through, and I want to wish them a very speedy recovery, because we get here 3 days a week to try to figure out how to make money in a bear market, how to protect our money. And this virus is just destroying families and businesses and just causing a massive amount of havoc on the economy. But I want to let you know, from my family to yours, I hope they get better real soon and can join us in becoming the smart money. So today the markets are pretty interesting. We've been looking at the kind of last week and a half in trading day terms of this quarter end, all of a sudden surge in equities, and everyone's like, the bottom's in, we have to buy stocks, and look, see, it's no big deal, 3 million unemployment and probably another 3 million tomorrow, who cares? It's the bull market is back, the bottom is in, and look, people are trying to sell bonds. And I thought, and the data kind of said from people who have access to this that I don't, that this was really just a rush at the quarter and rebalance from pension funds, institutional money managers, sovereign wealth funds. And lo and behold, April 1st, what do we see? Stocks are going, that's right, guys, get the bear arrow out, down. And Treasury yields, bonds going up. And what did that tell you? It's a big reversal of kind of the last, say, 7 or 8 trading days in the last week and a half. And so it tells us that perhaps that narrative is very true. Obviously, one day doesn't make the markets, doesn't change the trend. But when we look at the technicals of the market, it really is very interesting. I think the market is behaving very technically correct, at least in terms of what I see in the S&P 500 and the bonds. Now, for those of you who say, what do you mean by technically correct? Now, there's a lot of things that I don't subscribe to. For one of them, I'm not a big fan of Elliott wave theory. I get what it is, and really, to me, it's just a movement of prices between supply zones. And some people, I include the guy named Elliott who came up with it, is that it moves in certain waves and patterns before it changes. And I'm not a big fan of it. I think there's something to it, but to me, what's more interesting is, where are the buyers and sellers? That's what I want to know. And I want to look at these patterns. That's why I showed you the Wyckoff bottoming pattern that I think matches what's going on in bonds, because that does make sense to me. It's showing you an accumulation pattern of where buyers are at. And when we look at what's called technicals, we can see on a closer basis, day to day, where these buyers and sellers are at. And as some of them get pushed out of their positions, either one way or the other, it creates opportunity to either make money or, depending on what side of the fence you're on, lose money. And I think there's a lot to that. And I want to look at that when we get into the charts. But first, your questions. So let's jump right in. I got a bunch of them today. All right, first one, markets don't make any sense. How comes? Yes, they don't. How come sometimes yields are down and bonds are down as well? Why the lag time? I don't really notice that myself, and it could be depending on what bonds you're looking at. Are you looking at Treasury yields versus high yield bonds? Well, you're going to get a whole different picture. If you want to look at Treasury yields, you need to look at a Treasury bond ETF, such as if you're looking at short term, I believe it is SHY. I'll go confirm that just to make sure. Yes, SHY would be short-term treasuries. These are ETFs. IEF would be mid-term treasuries, and TLT would be long-term treasuries. And so what you would look at is SHY should compare with, say, roughly 90-day treasury yields. IEF is going to be your 7 to 10 year. Just look at 10-year treasury yields. That's going to match up. And TLT, you're going to look at 30-year. Now, on my trading charts, and this may be same as yours, so when we do look at charts, just so you know, the platform we're looking at is for institutional money managers. I shouldn't say institutional. I'm not an institutional money manager, but money managers on the institutional side of TD Ameritrade. So this platform is not publicly available. And I notice a lag between yields and bond prices too. My bond tickers seem to be far more accurate, and the yields seem to sometimes lag a little bit. Why that is, I don't know. So we'll just add that to the list of things that don't make sense. You rightly mentioned in this video that gold is extended technically. Yes, I believe that to be true. I think the evidence corroborates that, and that can cause it to pull back. Yeah, that's what happens when you get too many people on one side of the fence. And that's how you really make money in the markets on a macro scale. See, I'm a macro guy. I'm not a micro guy. I'm not worried about last week, this week. I mean, those who know me and know some of the positions, I will hold things for years because I am convicted about my research and where it's going. I'm looking at the big picture. And that's how macro is. I mean, you can be wrong, and then immediately you're the rightest person ever. I mean, that's how the world of macro works. You can just see what's coming. You just don't know when. So my view is you got a lot of people on one side of the fence in gold. And you've got a lot of people who think right now, because of what's going on with the coronavirus and all that, hey, you should buy gold. I don't fully subscribe to that. But in my general view is when you have a lopsided market, you generally can find money to be made when you take the opposing view. I mean, when you're one man against 1,000, it seems like the odds are terrible. But when you're right, man, and all those 1,000 people come rushing to your side, I mean, that's how you make money in the markets. So let's see. So however, from fundamental viewpoint, given the early first wave of panic liquidity run, so I think what the person asking a question is referring to the recent drop in the market. So the recent panic liquidity run is somewhat settled. Investors sitting on cash will try to find safe havens. Yeah, maybe. Okay, let's finish the question out. And gold is pretty up there as an option. See, I don't know that it is, and it wasn't in the past during the great financial crisis. Now, I was in the business during the great financial crisis, and I've gone back and I've studied it very, very well. I mean, I've intently, deeply, whatever word, I have just gone through and ripped this thing to shreds because I had a feeling that the next bear market, which we're starting now, or have started, was going to be a replay of the great financial crisis. And so far, my assessment is spot on. And just like with the great financial crisis, you saw this herd of running into gold because everyone thought, oh man, there's going to be so much inflation. But what they really didn't realize is the early effects of quantitative easing are deflationary or disinflationary before they become inflationary. And it's that deflationary effect, to me, which causes gold prices to go down. Now, so I don't even know. Let me go look. Let's use some real numbers. Where is gold at today? It's right at almost 1,600 now. So this is perfect. So let me give you an example of why gold goes down in these type of markets. Is let's say I get my hours cut at work, or I lose my job, or maybe I'm executive. I'm used to getting bonuses, or I'm in sales. And I'm used to hitting quotas. All of a sudden, I have less income, and I would normally like to buy gold, but now I have less income. So when I look at 1,600 an ounce and I now have less income, to me, it's like, oh, now it's really expensive. So I won't buy it. In fact, at that point, I might, take that old gold watch that's been sitting in my drawer for 10 years and say, hey man, at 1,600 an ounce, I'll go send that in to melt down. And then when prices come down, I'm a buyer. And you see that happen a lot during recessions where, those TV programs say buy gold, buy gold, buy gold. Then they'll turn into the one where showing gold melting down is full of rings and necklaces and watches. And that's when people send in their old gold, and they do that because the price is high. And I think we'll see that again. It could be wrong. It's just my opinion as what I think will happen again. So I don't think, and it's one of those things, safe havens, to come back to the question of what is a safe haven, is something that protects your money. Well, if it goes down when everything else goes down, it's not really a safe haven. That's why you see people eventually run to bonds, because they go up. Remember, part of the market is understanding your competition. If you're playing in a sports game like basketball, football, baseball, anything, part of the game is the psychology of whoever you're playing against. What does that person? Oh, that person at bat, they always hit to this part of the field, or they always do that, or there's things that people do. And in America, investors buy high. So right now, American investors aren't a big fan of bonds. Wait till they go up some more. They will see that and shift, and so will their financial advisors. I just think gold sells off again. It could be wrong. It's just what I think. What's your outlook on high yield and junk bonds? Bad, low, very. My outlook is poor. Now that the Fed is purchasing investment grade. So the problem for those of you who do not know what high yield or junk bonds is, those are bonds or corporate bonds that pay an above average yield because there is some element that the company that's backing those bonds will not be able to pay on. So my outlook in recessions is they're bad news, because guess when people tend to default on them is during recessions. Now, one of the biggest sectors in the economy who own high yield or junk bonds, or issue them, I suppose is the correct term, is the energy sector, which at $20 a barrel in oil, there's a lot of risk there, and the retail sector. So you've got malls and strip malls and things like that. So a lot of, and not to mention, well, you have the real estate aspect, but you also have the retailer side that have been issuing these things. Yeah, my outlook is, I wouldn't touch them myself, not during recessions. Will that put downward pressure on those prices further since the Fed is in person? Yes. I'll just show you real quick. Let's go. This is the chart of gold, but let's go look at a chart of, where's my bond section? Here it is, high yield, HYG. Here you can see back in 2008 and 9, poof, you went from 106 to 61, so nearly a 50% loss. Here we are at 88, and look, just falls right off a cliff, boom, boom, boom. And we can zoom in a little bit and you can see. So yeah, junk bonds are, I suppose you couldn't see that, could you? So there we go. Sorry about that. Let's zoom back out and you can see, here's your 2008 from 106 down to 61. Just look at that, just boom, like a waterfall. And you can see it happening here again if we zoom in. Just a quick way to lose money because there's no confidence in these companies being able to pay those bonds back. So no, my outlook is poor. And no, the Fed probably will not be buying those. Now, it wasn't the question, but the Fed shouldn't be buying them. Why they're buying investment grade is they're trying to keep them from going into junk. You covered how leveraged ETF for equities is risky. It is. Anything that's leveraged, whether it's 2 times, 3 times inverse, is always risky. Trade at your own discretion. I know there's some people that are going to, hear my warning and still do it, and that's fine. It's your money. You do what you need to do with it. But I will at least encourage you this: read the prospectus. Now, most people never read these things, but you need to read them because there are liquidation events in some of these leveraged ETFs, where if they drop a certain amount, you lose 100% of your money. Bet you didn't know that. You got to read them. Okay, let's go on with the question. How about leverage ETFs for Treasury and inverse ETFs for junk bonds? Probably not as risky as no, more risky than equities because the fees in these things are really high. So imagine this: if you're short the bond market through a inverse ETF, you are effectively paying the interest cost plus the fees of the ETF. That's why they're so expensive. In fact, I know there's a guy listening to this right now, and he's shaking his head going, "Oh God, please don't let these people buy like inverse HYG." This is a terrible idea. The fees are high. The risks are even worse because these things are just bad news. So you got to be careful with this stuff. I think they're even riskier than equities. And I've heard conversations with hedge fund managers. There's a guy by the name of Eric Townsend who does an institutional podcast. And there was a period where he would ask every person he had on every week what they thought about, being in, short the junk bond market. And they're like, man, that's really super risky. And he's like, I know, I kind of want to do it, but I mean, the cost is high, and you can lose a lot of money real quick on those. So he goes on to say, I've done some short on the FANG stocks with leverage and came out with a profit, but it took some time where those companies are so unlevered and financially in better shape. Yeah, I mean, it's like anything. I mean, whether you're leveraged or not, sometimes it takes time for your view to come out and play. Just understanding that these tools, these leverage and inverse, whether they're stock or bond or commodity, are extremely risky. 3 times the fun, 2 times the fun, 3 times the losses. And sometimes these losses can come overnight. I mean, look at today. Let's say you were triple short or triple long the S&P going in today. You're now down 15% if you didn't sell it. I mean, that's a quick way to lose your money. So be very careful with those things and read the prospectus. Do you not see this? Okay, question number 1. Do you not see this causing gold to rally? Dollar gold reverse correlation does hold well in unusual trading scenarios. However, during crisis time, do you not see those both rising? So the question, let me just narrow that question down to gold and the dollar can rise together. Do you think that happens again instead of being inversely correlated? Look, nothing is perfectly inversely correlated except Treasury yields and bond prices. And Treasury yields and Treasury bond prices, let me be more specific. So are there periods where the dollar and gold can rally together? Yes, there are. Is it possible it does it again? Yes, it is. Do I think it will? No, I don't. I mean, that's just my feeling. I don't think it will. I think it's going to play out just like it did in the great financial crisis, where we're going to see gold sell off, and then all of a sudden, boom, you're going to see the big bull market in gold. That's what I think. Could be wrong, but that's just my thoughts on that. But I could be wrong. They could rise together, and they have. Given there is a very high chance of bankruptcies happening across sectors in the rest of the year, yeah, there are going to be a ton of them. How do you think investors should play that? Here's what's interesting about bankrupt companies. American investors love them, and I don't know why. They love it. They think, oh man, that company just got thralled. They're filing bankruptcy. Their stock's tanking. Man, I'm going to put all my money in it. That's really cool. If you want to do that. Now, as a licensed advisor, because I get calls from people when there's a bankruptcy, hey, are we going to be buying in? No, we're not. Well, why not? Their stock's cheap. Do you understand? They file a bankruptcy. The stock could go to zero. People who own stock are the last, person to get paid. So they're, your risk exposure is losing all your money. Yeah, but such and such company won't go to zero. We don't know. What I do know on a personal basis is, let's say I put a bunch of people in a bankrupt company stock and it went to zero and I got sued, which it could happen. And I had to go to court and the judge says, so Steve, why did you put all your clients in this bankrupt company stock? And, well, because there was a huge opportunity for it to go up. Yeah, you're an idiot, and judgment to them. Right. That's kind of how my view is. So let's say that you did want to play that game and you weren't licensed like me, which I presume you're not. Here's what I would do, even though I wouldn't do it, but if I had to do it, this is how I would do it. Let's say there's 10 bankrupt companies alike and I got $10,000, 1,000, 10 times across. Why? Because I got to assume that a fair number of them are going to zero. I don't want to put all my eggs in one basket. That's what I would do. I wouldn't do it, but if I had to do it, that's how I would do it. Spread your risk around. Treat them like a penny stock. Next question. Very few people seem to understand the monetary cycles in the economy. Yeah, that is a solid statement right there. We see deflation of values everywhere. Correct. Probably the biggest driver is technology. Absolutely. As human progress increases, doing more with less, and expands at a rapid rate, more quantitative easing is needed to support the economy technology enables. Do I agree? 100%. I agree with that. I mean, you got to think, go watch an old TV show from the 50s. And people's job was to stand in the elevator all day and push the button on the floor that you wanted to go to. Now, some of you who are young enough would say, I mean, you've probably seen it on TV, but could you imagine going to a store and not, or our office building and not pushing the button on the elevator? Yeah, so technology displaces jobs, puts more pressure on the Fed to do QE. Now, there is this belief that technology does create new jobs, and that is true, but does it create as many? I don't know. I don't think the evidence doesn't seem to support that. VIX crashing is a sign of lower money velocity, ? It's not. What chart do you look at as the best indicator of money velocity? I will show you. I look at the chart on money velocity through the Federal Reserve Economic Database, or FRED, fred.stlouisfed.org. This is free, and it's called the velocity of M2 money. So you can look that up. So just for fun, I overlaid the volatility index, and you can see there's absolutely no relationship between, let me see, the question was, VIX crashing is a sign of lower money. No, there's no evidence. You can see the two generally, you can almost say the opposite is true if we inverted this. In fact, let's invert the VIX for fun. Let's see if it looks a little bit better. I wouldn't say this is really a relationship that I would stake my claim on, but it looks pretty decent. So it actually, except for this move right here, it would suggest to me that potentially rising volatility leads to a lower money velocity, not the other way around. So that if I had to stake my opinion on it, that's what I would do. But the relationship isn't really tight enough for me to be too confident about. Next question, 2.2 trillion seems like a lot of cash out of the system from outside the usual Fed process. Does this impact the outcome on bonds versus security you're expecting? It does not, because it is following the same process it always does. The government is going to borrow the debt, and then the Fed is going to turn around and effectively monetize it at the tune of $60 billion per day. They're not going to get all of it, but they will eventually get it. It'll take them a month to buy it all. To buy $2 trillion worth. It looks like $350 billion will be forgivable debt. Isn't this money that's just outside the usual system of printing loans? No, this is not. No money is outside the usual system in this case. So the idea is, I'm going to lend you money. You're going to pay me an interest cost. And if you meet certain criteria, I'm going to forgive the loan. This is, from a monetary perspective, dumb. Okay. Now, I get why the government's doing it. So don't get me wrong. I understand all the logical reasons why. Now let's talk about from a system perspective. When a loan is paid back, or when a principal value of a loan is paid, whether it's part of the monthly payment where a piece of its principal or a principal payment is made, it destroys money. When a loan is defaulted on, it destroys the money. When a loan is effectively forgiven, the money is destroyed. So assuming this $350 billion, which is injected into the economy, and everyone who gets it meets all the requirements and the principal value is destroyed, the principal value is destroyed. $350 billion was borrowed, put in the system, is gone. Yeah, doesn't make sense to me. What is historical precedent? I don't know. The Fed seems to be buying up more than just corporate bonds now. Well, they're buying mortgage-backed securities and treasuries. I believe their corporate program is some sort of loan or bad asset bank or something that they don't hold on their balance. They're not holding them on their balance sheet. I can tell you that. They've got some creative way that they're going to dispose of these at some point in the future or put them back in the market. They're very good about it, but I can assure you the Fed is going to stick to the letter of the law, stretch it as far as it can without getting in trouble, but they're not going to hold them on their balance sheet. Can you explain how the commodity crash, so falling oil prices, copper prices, will impact world dollar liquidity? In the short term, it won't help, because what happens when you get falling commodity prices, let's use oil because I'm in an oil town in California. So falling commodity prices mean many of my clients, friends, neighbors, and whatnot are all out of work. That's what it usually happens. That's not good for the economy. But what eventually happens is prices get low enough where demand starts to come back. And that's good, because as long as we go and buy foreign produced oil with dollars, then it helps world dollar liquidity. In the short term, it doesn't. But in the long term, it does. And this is kind of how the monetary system needs to work. When you contract, the number of dollars, so I'm using my hands like a globe. So when you contract it, the whole system, the world just has to shrink down to that level. And that's why, in addition to the coronavirus, we're seeing oil prices fall and other commodity prices fall. It's just contracting down to the level of dollars until it's low enough where demand comes back and says, hey, at 20 a barrel or 10 a barrel or maybe a 0 barrel. I don't know where oil bottoms, but someone says, hey, I can make money at that price point. There you go. Next. What if foreign central banks stop buying newly minted treasury bills? Nothing. This is genius. I used to subscribe to that because I was uneducated in my own ways, and I believe the mainstream views that were being taught about the system. And when you go back to the great financial crisis, the architects of the repair team, the people who fixed the financial system, thought of that and said, hey, what if what foreign central banks don't buy treasuries? So they created an outlet in the auction system that says that any treasury securities, bills, notes, bonds, doesn't matter, that there's nobody wants to buy, the large commercial banks must buy them. Must. No choice. I don't know how it gets split up, but they must buy them. And you see in the auction data, what you'll see is domestic bidders, foreign bidders, and then securities dealers, which happen to be owned by large commercial banks. Securities dealers get whatever's left over. Think of it like, you're done with dinner and you've got some scraps of meat and stuff, and the dog's sitting there wagging his tail, begging, and you're like, here you go. Yeah, well, the large banks are like the doggy bag. You send it out and that they pick up whatever's left. Okay, next question. What will our commercial banks do with all the paper on their books? Nothing. Will that impact bond yields? Yes, cause yields to go lower because they've got all that paper on their books, and that limits how much private investment or loans they can do because they've got to deal with all this Fed or this government debt. All right, last question, which is going to have a longer answer. Can you please explain the Fisher equations? These are great questions this week. Keep them coming, and I will do my best to answer them. So what is the Fisher equation? Well, here it is. And the Fisher equation is the real interest rate, which equals a nominal rate less the inflation rate. So let me give you some examples what this means so it makes sense. And anytime I look at something, I just put some numbers to it. And I always like to exaggerate the numbers. I think it helps me understand it better. So let's pretend that I have money at a bank earning 5% real return in some sort of savings account or CD. And inflation is 7%. So I'm earning 5, inflation's is 7, so I have a minus 2% per year net loss because the purchasing power of my money is not keeping up with inflation. That's what the Fisher equation is telling us here. Now let's look at a bond example, and I've got several. And these are real numbers. So roughly today, when I put this together yesterday, the 30-year Treasury yield is 1.3%. See, it says return. And inflation, according to the CPI index, was 2.3. So 1.3 minus 2.3 means there's a minus 1% net loss. Now, this is interesting because the reason there's so many people shorting the bond market is inadvertently you could look at the Fisher equation and say, what idiot would want to own bonds when they're losing money? This guy. Why? Because I know something they don't know. And I'm going to share that with you right now. And it's going to be so cool because this is why people get bonds wrong and buy them too late in a bear market. They always buy them at the bottom of the bear market when they should be buying them at the late stages of a bull market when everyone's still going googly-eyed over stocks. So let me show you why. This is great. You're going to love this. And for the person who asked me for more charts, you shall get some more charts. Inflation follows yields. Let me say it again. Inflation follows Treasury yields. You want to know how the world is going to work? Study the bond market. And study it. It teaches you so many things. It tells you what's going to happen. It just doesn't tell you when. It just tells you what's going to happen. So when yields in red go down, inflation goes down. And when yields go down, inflation goes down. And when yields go up, inflation goes up. And look during recessions, yields go down, inflation goes down. Yields are going down, And you go, well, why is inflation up here at 2.3? Why isn't it going down? Oh, good. I'm so glad you asked that question. And the answer is because there's a lag in yield, or a lag in CPI. CPI is one, not quite the most lag data out there, but it's about 6 months behind. It's old news by the time it's even prints. So the Fed, who loves CPI, actually they like PCE, virtually the same difference, but doesn't matter. It's still a metric of inflation. It lags. And so investors looking at this Fisher equation go like, oh, hey, only an idiot would buy bonds. And now let me show you why the idiot in this picture loves bonds, because he's going to be right about it. So now you know that yields follow, or CPI follows yields. But how about some more evidence of that? So let's look at the money multiplier, which tells us how many times a bank can lend against its reserves, or in Steve's view, how many times money gets out in the wild before it dies. How many times does exchange hand before it dies? And I said quantitative easing is disinflationary or deflationary. Well, if we overlay the consumer price index, which is done on a year-over-year basis, you can see during the great financial crisis, when the Fed did a monster QE program, look what happened. Boom! It crashed. Now you can say, well, wait a minute. When they did their next QE round, CPI went up. Remember, it's lagged. It's not real time. It's not like they're connected into Amazon's pricing system. And no, it's lagged. But look, it eventually went down. And then the Fed did QE3 and inflation went down. So what does it tell us? It tells us that the consumer price index is going to go down on a year-over-year basis. Now, if we mouse over this or zoom in, because I can't, excuse me, you can see that the CPI index got down to -2. We'll hang on to that thought. Let's keep going with this. Look, how about compared to the dollar? So we have trade weighted dollar in blue, which is rising, and I believe will continue to rise for a while, against the consumer price index. And you say, well, I don't see anything here. All right, I will help you with that. Let's go to the dollar chart and let's invert it. And there it goes. Voila! Now you can see a rising dollar pushes consumer prices down. So a rising dollar, guess where you think consumer prices are headed? Okay, so hopefully this starts to make sense to you. Now let's go back to that Fisher equation and see why being in bonds is not as dumb as everyone thinks it is. So, bond example number 2. Let's say I buy a 30-year Treasury at 1.3%. And inflation 0. Now I have a net gain of 1.3. So now all of a sudden, I don't look so dumb. In fact, I look pretty smart, because due to this inflation going down, I have a net gain, and all of a sudden other investors and professionals are going to see this. Now, what if inflation goes negative, which I believe it will, on a year-over-year basis? So let's take that same 1.3% 30-year bond that everyone laughed and said when I bought it, and you subtract a negative number, so minus a negative 1%. I now have a 2.3% positive gain, because I understood how the system worked. I knew that CPI was lagged. I knew that it follows yields lower. I knew that a stronger dollar brings consumer prices down. I understand these things. I knew the money multiplier is telling me the truth, and I can validate it that consumer prices are going down because the Fed is engaging in a deflationary act by quantitative easing. That's how you come to smart money, and you get ahead of everyone, and people say, you're an idiot for buying bonds. And then later on, they're like, man, that was really smart. How did you know? You got lucky. That's what they always say. Oh, you got lucky. Yeah. No, it's because I studied this stuff inside and out, and I challenged the view that everyone else had. And I did that not because I thought they were wrong, because I wanted to prove that they were either right or wrong. And when I found out they were wrong, and I found that out because there seemed to be this recurring theme of the smart money, which I can see in the futures positioning, was always doing the opposite of everyone else. I'm like, well, what do they know that no one else does? And everyone said, well, they're wrong. They're stupid. Look, they're buying bonds and no one else is. And well, the more I dug around, I'm like, oh, they are really smart. They know how the system works. And now you do too. Okay, let's take a look at some quick charts. This is going a little longer than I expected, but you give me some great questions. And I don't mind answering them as long as you don't mind asking them. So as long as you watch, I will answer. When you give up, I will go on to something else. All right, let's look at the S&P 500 and look at these technical levels. So what we're seeing here is the S&P 500 got up to 2,600 and ran out of steam. I'll zoom in a little bit here to help you. And remember, I had this view that rate cuts tend to act like a ceiling for stock prices. Well, it looks like it did, because today we gapped down, meaning prices from yesterday's close and this morning's open, there's a gap in prices formed. And where does this line from 2,600 go back to? Well, zoom out our chart a little bit, and we'll have to rescale it so we can see properly. So 2,600 kind of goes back to the bottom of 2018. And yeah, mostly back 2018. So it went up here to find out, hey, were these people that bought back in 2018, maybe some of these people bought in late 2018 and some people that bought in early 2019, are they still buyers? And the answer is no, at least no right now. So now that tells us that the next destination for the S&P 500 is 2416, a technical level that goes back to, whoops, that's not what I wanted to do. Sometimes you click the wrong thing. Goes back to find out now, or in 2017, are the people that bought in mid to late 2017, are they buyers? So we're going to come back and then find out, what about these people that bought in late December 2018, early 2019, are they buyers? If they're not, the next destination I think goes through 2200 and back to 2100 to retest, to find out, are the people that bought right before the election, are they still buyers or not? And you go back to the peak back in 2016. That is the destination. So that's what I think there. Let's take a look at TLT. And this thing is just technically behaving very, very well. So what happened is we broke through this resistance level where people had previously sold at around 166.70. 166.60, and it went up and tested another layer of what's called resistance, where sellers were previously going all the way back to March of this year. And yes, there were still some sellers at this level. And so today, or last night, bond prices rallied in overnight trading, didn't quite get up to the highs, but the sellers were back. And let's zoom in and we can see it got up there and selling, and it came down and retouched support. Now this is very interesting because the support channel goes all the way back to March, and you see early March, and then all the support here. So why was this important for bond prices to do this? Why did it need to do this? Because it was going back to check in to say, hey, anybody that sold here, or back here, you still want to sell? You got anything left that you want to sell at that price? And the answer was no. Now, I don't know if this will hold, but it's interesting. We can see in after hours trading, bond prices shot right back up to nearly their highs of the day. So that's very, very interesting to me from a technical standpoint. Let's take a quick glance at the dollar. It's trying to fight through this support channel and get back up here. The Fed's trying to do everything it can to avoid that. I think the Fed loses. And then the big question is emerging markets. What's going on with EEM? You see this purple line down here? This is where, if there is a bottom forming in the markets, it needs to hold this line. I mean, it's got to. It's already in the volatility is high past that shaded line. And now these are something I created. I've never seen anyone else come up with these lines. But let's look at the 6-month view. It came down, found support at that little purple line, and it bounced up here. It's trying to find liquidity and is selling off. If it comes through that purple line again, we are, in my opinion, we're very quickly looking at a massive sell-off in the market. This is kind of the point of last return. It's got to hold there. Maybe it holds down here, but it's not a good sign for the markets at all. So appreciate you taking the time to watch, and hope this is really valuable for you as you learn about how the system really works. And that's kind of what I like to share with people is all those years I spent digging into the system to try to make sense of these markets, to be a better investor, to be the smart money, to be on the right side of the market, whether it's in a bear market or bull market. I need to know, because in bear markets, I want to be more in bonds. In bull markets, I want to be in stocks. And now you know that why everyone thinks buying Treasury bonds is dumb are going to be buying them when the Fisher equation tells them the real yield is positive. I'm Steve Van Metre. Thanks for watching. We'll be back Friday and take a look at the macroeconomic data and try to make sense of markets that still don't make any sense and answer your questions. Bye now. The content of this video is provided as information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.